Hello and welcome to Any Answers Answered for September 2024. Hopefully everybody has had a good summer and we're straight back in with questions. The first from LDS24. And Tim, LDS's question on training expenses, whether they're allowable. Basically, LDS says, I am aware of the rules from HMRC being improving skills, keeping up to date on industry skills, etc. is an allowable expense, and learning a skill to start a new business is not an allowable expense. However, here is the situation. A self-employed client is currently a dog walker, dog sitter. They are looking at starting dog grooming. So, wants to do a dog grooming course to offer this mostly to existing clients. Is this an allowable expense? Tim, exactly as asked. Can they deduct it?
Well, as you can imagine, Giles, there are mixed views on this. And at the time of recording, there have been 21 replies to this doggy query on Any Answers. And the original poster, LDS24, did highlight two links to gov.uk pages, HMRC guidance on this, that they say they've been looking at. And one is expenses if you're self-employed / training courses, and the other is check if the cost of training could be an allowable expense. Well, the first of the posters in response to this says not allowable, brackets without looking it all up, which I might do later. Learning a new skill to start a new business is not an allowable expense. And here's the example, a driving instructor, brackets cars, who pays for a course in how to train lorry drivers in the hope of expanding into a new sector will not be able to treat that cost as allowable. But if they took a refresher course, focusing on the difference between electric vehicles and petrol or diesel cars, then it might well be allowable. And then somebody replies, liking the examples. Cat's Whiskers says not allowable. Ivor Windybottom gives further relevance here, further reference rather to HMRC manuals, but said the question is really whether the client has a dog services business or just a more narrowly defined walkies business. And the examples in the HMRC internal manuals at BIM 35660 seem quite close to moving from dog walking to dog grooming. And what else can I say? I mean, I think it's one of those grey areas. So the advice that one of the correspondents gives is actually that there is an argument for it to be a development of the dog grooming business. And what they should do is to make a claim for the expense of the training and to white space it, giving a note in their tax return saying they've claimed it on the basis that it is related to the existing trade. One of the examples given is of a gas boiler fitter retraining to fit heat pumps. There are mixed views, basically, which is probably why there was a question. If it's a dog care business, then that would incorporate grooming as well as walking. And I think we've had enough of looking at all of these answers, but fundamentally, what this does is highlight that there is some debate as to when training for something that goes beyond your existing services, not just refresher courses, etc., could be tax deductible. I will just quote one final response from Kevin Ringer, who's always worth reading. Dog walking businesses often offer a greater range of services than literally just walking. And the client's dogs, and this accountant, Kevin, has dog walking clients, and they're often housed in the owner's home, but the client will have a key to the house, let the dog out, maybe feed it, clear up any mess, transport it, maybe do more than just walking, spending time with the dog, very often grooming the dog as part of the welfare. So yes, Kevin is of the view that this could indeed be tax deductible, and that's enough on that.
And I think it's very important to remember that the budget day announcement this year, which wasn't part of the budget, it just happened to be announced on budget day, was the revenue completely changing their guidance, though they said it was just clarification of the guidance, in terms of self-employed training costs. And the message there, as I've been covering it in lectures, is very much to say anything that you're basically sitting at the same desk to do. So if it's a development of skills that is basically within the same overall picture, then that's okay. And that's a much more relaxed picture. The example I often do is if you're an accountant who wants to do their tax exams. This traditionally would be something you probably wouldn't have claimed. Now I think you very definitely can. That's why I like this idea of, I think you called it dog services. I think a dog services idea very definitely would allow this, where possibly in the past we wouldn't have been able to. Anyway, our second question this month, it comes from RMA. An RMA asked a question on capital losses from a previous period. We have a new client who has made a capital gain in 23-4, but has also shown evidence to the accountant of an unused capital loss from a previous period which was never reported on a tax return. We're now out of time to submit an amended return for the year in question, but would like to utilise these losses in 23-4. What is the best course of action here? Now, should they white space it, things like that? Tim, I'm going to let people in on a secret here. If you work with Tim long enough, you learn that as I read this for the first time, I could picture him flinching at the very thought. Tim would never have submitted a return without detailing exactly what this particular loss was. Our last conversation on this was about overlap profits and the absolute essential requirement to include an overlap profit figure as you go, so it's always there. Tim, you'd never file a return without the right figures in it, would you?
Absolutely, and for one very good reason, and that is that the legislation does impose strict conditions on the availability of a capital loss being carried forward against future capital gains. Now, if there is a capital loss, as most will know, you can offset that loss against gains of the current tax year or carry it forward indefinitely against gains realised in future tax years. However, in order for that loss to be available for carry forward, it must be notified to HMRC. And picking up on what you just said about me, it seems to me the most obvious way of notifying would be to enter it in the tax return for the year in which the loss was made. Now, what's interesting about this particular question posted in the Any Answer section is that the original poster did not tell us when the capital loss was made. They simply said there's evidence of an unused capital loss from a previous period. There are only, at the time of recording, 4 replies. And the first of them is, in which year was the loss? And we're then told by the original poster that the year was 21-22. And then John Harris 999, who asked in which year was the loss, quite right, reminds the original poster that you have 4 years from the end of the tax year of loss. So for a 21-22 tax year loss, you have until 5th April 26, so another 18 months or so, within which to notify the revenue of the loss. Ideally, it should have been on the 21-22 tax return, but it doesn't matter. We are within time to do that, and it can be reported any old how. What John Harris 999 says is letter, side of a cow, etc. Well, leaving aside the humorous element of that, the 40 Basel 2575 says, here's the legislation and recommends a belt and braces approach, a letter to HMRC setting out the facts and the workings for the loss, and of course the date. And on entering the loss figure in box 45 on page CG3, an entry in box 54 on page CG4, stating that the entry is as per the letter from my accountant, blah, blah, blah. And so, yes, you can get the relief, but you do need to notify that capital loss. And it's well worth reminding viewers that a capital loss has to be notified within that 4-year time limit. So if you're not within self-assessment or you've just not put it on an earlier tax return, you run the risk of losing the tax value of that loss. And very often, of course, capital losses are not going to be used for many years hence. So it's well worth checking with clients whether they've got any and to make sure that they are reported.
And just to bail RMA out here, very clearly in the message that we got in the question, it says new client. So we're not suggesting that they should have done this work whenever it was. We are suggesting actually that somebody else hasn't put this on a previous return.
Just to pick up slightly on that, it could be a PAYE taxpayer who's come along and said, I've got a capital gain, but I did have a capital loss. Well, they didn't do self-assessment, but there should be that separate notification.
Absolutely right. Also a very valid point. Hopefully useful to the two people who asked those questions and many others besides. Tim and I will be back next month, and we look forward to answering possibly your question next time we see you. For now, bye-bye.